If you're holding physical gold bars right now, there's something happening in the custody and storage world that you absolutely need to understand. And I'm not talking about some minor regulatory tweak that doesn't affect you. I'm talking about fundamental shifts in how gold is being stored, who's controlling it, and what that means for anyone holding physical precious metals. Let me start with what's actually changed, because this isn't getting the attention it deserves. Central banks around the world are in the middle of the largest gold repatriation movement we've seen in decades. Between 2022 and 2024, central banks purchased over 3,000 metric tons of gold. But here's what's really interesting. They're not just buying it, they're moving it. They're pulling gold out of traditional custody arrangements in London and New York and building their own vaults. Why does this matter to you as an individual gold holder? Because when the biggest, most sophisticated players in the gold market are fundamentally changing how they store their gold, it's telling you something about the future of custody arrangements. Let me give you a specific example. China has launched what they're calling a strategic gold custody program. Now, on the surface, this sounds like an internal Chinese banking matter. But dig deeper and you realize what's actually happening. China is creating an alternative custody infrastructure that operates completely outside the traditional Western system. They're not just storing gold differently, they're building a parallel system. And they're not alone. Russia repatriated hundreds of tons of gold from foreign vaults over the past few years. Turkey did the same thing. Even Germany, a close U.S. ally, spent years bringing their gold home from New York and Paris. When Germany's Bundesbank completed their repatriation in 2017, they had moved 674 tons of gold. That's not a small amount. That's a statement. So what's driving this? Why are central banks suddenly so concerned about where their gold is physically located? The answer comes down to one word: sovereignty. Or more specifically, monetary sovereignty in an increasingly fragmented global financial system. Think about what happened when Russia invaded Ukraine. Within days, Western nations froze hundreds of billions of dollars in Russian foreign exchange reserves. Money that Russia thought was safely stored in Western banks became inaccessible overnight. Now, those were currency reserves, not gold. But the message was clear. If your assets are stored in someone else's jurisdiction, they can be frozen, seized, or restricted at any moment. Gold that's physically in your possession, or in a vault in your own country, can't be frozen by a foreign government. It's that simple, and central banks are acting on this realization. But here's where this connects to you as an individual holder of gold bars. The same logic that's driving central banks to repatriate their gold applies to private holders. If you own gold bars, where are they? Are they in your physical possession? Are they in a bank safety deposit box? Are they in a third-party storage facility? And critically, who has legal custody? This is where things get complicated, and where recent changes in custody arrangements are creating real risks that most gold holders don't understand. Let's talk about bank safety deposit boxes first, because this is where a lot of people store their gold, thinking it's safe. Here's what you need to know. When you put gold in a safety deposit box, the bank is not acting as a custodian. They're renting you space. The contents of that box are not insured by the FDIC. They're not covered by the bank's insurance. If something happens to that gold, if the box is drilled, if there's a flood, if the bank goes under, you have very limited recourse. And here's something that's changed recently that most people don't know about. Banks are increasingly restricting what can be stored in safety deposit boxes. Some banks are now explicitly prohibiting the storage of cash and precious metals. Why? Because of anti-money laundering regulations and the administrative burden of dealing with high-value contents. So if you're storing gold bars in a bank safety deposit box, you need to check your bank's current policy. Because what was allowed when you opened that box 5 years ago might not be allowed today. Now let's talk about third-party storage facilities, because this is where the custody landscape has really changed. There are essentially 3 types of third-party gold storage: allocated, unallocated, and segregated. And the differences between these 3 arrangements are absolutely critical. Allocated storage means you own specific bars with specific serial numbers. Those bars are yours. They're segregated from everyone else's gold. If the storage facility goes bankrupt, your gold is not part of their assets. It's your property, held in custody. Unallocated storage means you own a claim on a certain amount of gold, but you don't own specific bars. Your gold is pooled with everyone else's. You're essentially an unsecured creditor of the storage facility. If they go bankrupt, you're in line with all the other creditors. Segregated storage is similar to allocated, but with an additional layer of separation. Your gold is not just identified by serial number, it's physically separated in its own space. Now here's what's changed. The cost differential between these storage types has widened significantly. Allocated and segregated storage costs have gone up as facilities deal with increased insurance costs, security requirements, and regulatory compliance. Meanwhile, unallocated storage remains cheap because the facility can use your gold for their own purposes, lending it out or using it as collateral. This creates a dangerous incentive structure. Storage facilities are pushing customers toward unallocated storage because it's more profitable for them. But unallocated storage gives you significantly less protection. And here's the really concerning part. Some storage facilities that claim to offer allocated storage are not actually providing true allocated storage. They're providing what's called fractional allocated storage, where they don't hold 100% of the physical gold backing their allocated claims. They're operating on the assumption that not everyone will want their gold at the same time. Sound familiar? It's the same fractional reserve system that banks use with deposits, and we all know how that can end. There was a case a few years ago with a storage facility in the UK that claimed to have allocated storage for their customers. When customers started asking for physical delivery, it turned out the facility didn't have nearly enough gold to cover all the allocated claims. The facility went into administration, and customers are still fighting to recover their gold. So if you're using third-party storage, you need to verify that your storage arrangement is truly allocated, that the facility is audited regularly by independent auditors, and that you have the right to inspect your gold or take physical delivery at any time without restrictions. Now let me talk about something that's particularly relevant if you're thinking about gold as part of your retirement strategy. Gold IRAs have become increasingly popular as people look for ways to protect their retirement savings from inflation and currency devaluation. But here's what most people don't understand. When you have a gold IRA, you don't actually possess the gold. It has to be held by an IRS-approved custodian. And the rules around gold IRA custody are very specific. The gold has to meet certain purity standards. It has to be stored in an approved depository. You can't take personal possession of it without triggering a distribution and potential tax penalties. Now, I'm not saying gold IRAs are bad. For many people, they make a lot of sense as a way to get precious metals exposure in a tax-advantaged account. But you need to understand the custody arrangement. You need to know who the custodian is, where the gold is stored, what the fees are, and what your rights are. If you're sitting on a significant retirement account, say $100,000 or more, and you're concerned about inflation and dollar devaluation, a gold IRA might be worth exploring. I've put together a free guide that explains how they work, what the rules are, and how to evaluate different custodians. It's in the description if you want to check it out. But whether you go the gold IRA route or not, the key point is this: custody matters. Where your gold is stored, who has legal title to it, and what protections you have are just as important as owning the gold in the first place. Now let me tell you about another major change that's happening in the gold custody world, and this one is driven by technology. Tokenized gold is becoming a real thing. Companies are now offering digital tokens that represent ownership of physical gold stored in vaults. Each token is backed by a specific amount of gold, and you can trade these tokens on blockchain platforms. On the surface, this sounds great. You get the benefits of gold ownership with the liquidity and ease of trading of digital assets. But here's the custody question. Who actually owns the gold? When you buy a tokenized gold product, you're buying a token that represents a claim on gold. But do you have legal title to that gold? Can you take physical delivery? What happens if the company that issued the token goes bankrupt? These are not theoretical questions. The crypto world has shown us repeatedly what happens when custody arrangements are unclear or when companies commingle customer assets with their own. We saw it with FTX. We saw it with Celsius. We saw it with multiple crypto lending platforms. Now, I'm not saying tokenized gold is necessarily bad. Some of these platforms have robust custody arrangements with independent audits and clear legal structures. But you need to do your due diligence. You need to understand exactly what you're buying and what your rights are. And here's something that's particularly concerning. Some tokenized gold platforms are offering yields on your gold holdings. They're paying you interest for holding gold tokens. Where's that yield coming from? In most cases, it's coming from lending out the underlying gold, which means your gold is not sitting safely in a vault. It's being used as collateral in the lending markets. Again, this might be fine if you understand the risks, but if you think you're buying a safe, stable gold holding and it turns out your gold is being lent out to hedge funds for short selling, that's a very different risk profile. Let me give you a specific example of why custody matters in the gold market. In 2011, MF Global, a major commodities broker, went bankrupt. They had been using customer funds, including funds that were supposed to be segregated, to make risky bets on European sovereign debt. When those bets went bad, the company collapsed. Customers who had gold stored with MF Global found themselves in a nightmare situation. Even though their gold was supposed to be segregated, even though they had specific bar numbers, they couldn't get their gold. It was tied up in bankruptcy proceedings. Some customers waited years to recover their gold. Some never got it all back. And here's the kicker. MF Global was a regulated entity. They were supposed to follow strict rules about customer segregation. But when push came to shove, those rules didn't protect customers the way they thought they would. This is why central banks are building their own vaults. This is why sophisticated investors are increasingly taking physical possession or using highly secure, fully allocated storage. Because when things go wrong, custody is everything. Now, let me talk about what's happening with gold storage capacity, because this is another major change that's unfolding right now. There's a global race to build gold vaults. Not just any vaults, but massive, state-of-the-art facilities that can handle the kind of gold flows we're seeing from central banks and institutional investors. Singapore has positioned itself as a major gold storage hub, building multiple high-security vaults and offering favorable tax treatment for gold storage. Switzerland, long the traditional center of gold storage, is expanding capacity. Even places like Dubai and Hong Kong are building new facilities. Why does this matter? Because the location of gold storage is becoming increasingly strategic. It's not just about security. It's about jurisdiction, tax treatment, and access to different markets. If you're storing gold in the U.S., it's subject to U.S. laws and regulations. If the U.S. government decides to restrict gold ownership or impose new taxes, your gold is within their reach. If you're storing gold in Singapore, it's subject to Singapore's laws. Different jurisdiction, different rules, different risks. This is why you're seeing wealthy individuals and family offices diversifying not just their gold holdings, but the locations where that gold is stored. They're spreading risk across multiple jurisdictions. Now, for most individual gold holders, storing gold in multiple countries is not practical. But the principle still applies. You need to think about jurisdiction and legal risk when you're deciding where to store your gold. Let me tell you about another change that's affecting gold custody. Insurance costs are going up. Gold storage facilities are facing higher insurance premiums due to increased security threats, higher gold prices, and a more challenging insurance market overall. These costs are being passed on to customers in the form of higher storage fees. But here's what's interesting. Not all storage facilities are created equal when it comes to insurance. Some facilities have comprehensive insurance that covers theft, loss, and damage. Others have limited insurance with significant exclusions. Some facilities require customers to obtain their own insurance. If you're paying for gold storage, you need to understand exactly what insurance coverage is in place. Is your gold fully insured? What are the exclusions? What's the claims process? Who's the insurance carrier? I've seen cases where customers thought their gold was fully insured, only to discover after a loss that the insurance had significant limitations or that the facility's insurance didn't actually cover customer gold, only the facility's own inventory. This is particularly important if you're storing large amounts of gold. If you have $500,000 worth of gold in storage, you need to make absolutely certain that it's properly insured and that you understand the terms of that insurance. Now, let me talk about something that's particularly relevant right now, the relationship between gold custody and the broader financial system. We're in a period of significant stress in the banking system. We saw bank failures in 2023. We're seeing ongoing concerns about commercial real estate exposure, interest rate risk, and liquidity. When banks are under stress, safety deposit box access can become an issue. There have been cases where banks have restricted access to safety deposit boxes during periods of financial stress. There have been cases where banks have drilled boxes to recover unpaid fees. There have been cases where banks have closed branches and required customers to move their boxes with very short notice. If you're storing gold in a bank safety deposit box, you need to have a backup plan. What happens if the bank closes that branch? What happens if the bank fails? Do you have the ability to quickly move your gold to another location? This is why some gold holders are choosing to store their gold at home in a high-quality safe. Now, home storage comes with its own risks. You need proper security. You need insurance. You need to think about fire protection and natural disaster risk. But for some people, having their gold immediately accessible and under their direct control is worth those risks. The key is to make an informed decision based on your specific situation. There's no one-size-fits-all answer to gold storage. It depends on how much gold you have, where you live, what your security situation is, and what your risk tolerance is. Let me give you another example of why custody arrangements matter. In 2013, Cyprus had a banking crisis. The government imposed capital controls and actually seized a portion of bank deposits over a certain amount to bail out the banks. People who had money in Cypriot banks lost access to their funds. ATMs were limited, wire transfers were restricted. But here's what's interesting. People who had gold stored in private vaults outside the banking system maintained access to their wealth. They could sell their gold, they could move it, they could use it. The capital controls didn't affect physical gold held in private custody. This is an extreme example, and most people will never face a Cyprus-style banking crisis. But it illustrates the fundamental point. Assets held outside the banking system, in your direct possession or in secure private custody, give you options that bank-held assets don't. Now, let's talk about what's happening with gold custody in the ETF market, because this affects a lot of people who own gold through ETFs without realizing the custody implications. When you buy shares in a gold ETF like GLD, you're buying shares in a trust that owns gold. The gold is held by a custodian, typically a major bank. You don't own the gold directly. You own shares in a trust that owns the gold. Now, the major gold ETFs have robust custody arrangements with regular audits and published bar lists. But you need to understand what you actually own. You can't take delivery of physical gold from an ETF unless you're an authorized participant with a very large position. For most retail investors, a gold ETF is a paper claim on gold, not physical gold ownership. And here's something that's changed recently. Some gold ETFs are now offering different share classes with different custody arrangements. Some are offering allocated storage, some are offering segregated storage. The fees vary based on the custody arrangement. If you own gold through ETFs, you should understand the custody structure of the specific ETF you own. Read the prospectus. Understand who the custodian is, where the gold is stored, and what your rights are as a shareholder. Let me talk about one more major change in the gold custody landscape. Regulatory scrutiny is increasing. Governments around the world are paying more attention to gold storage facilities, particularly in the context of anti-money laundering and tax compliance. Storage facilities are facing increased reporting requirements. They're required to verify customer identities more thoroughly. They're required to report certain transactions to authorities. This is generally a good thing for legitimate gold holders because it means storage facilities are being held to higher standards. But it also means more paperwork, more compliance costs, and potentially more government visibility into your gold holdings. If you're storing gold internationally, you need to be aware of reporting requirements in your home country. In the US, for example, you're required to report foreign financial accounts over certain thresholds. Depending on how your gold storage is structured, it might fall under these reporting requirements. I'm not a tax advisor, and you should consult with a qualified professional about your specific situation. But the key point is that gold storage is no longer a completely private affair. There are regulatory and reporting considerations that you need to be aware of. So let me bring this all together and tell you what you need to do if you own gold bars or are thinking about buying gold. First, understand your custody arrangement. If you're storing gold with a third party, know exactly what type of storage you have. Is it allocated? Is it segregated? What are the fees? What's the insurance coverage? Who's the custodian? Where is the gold physically located? Second, verify your storage arrangement. Don't just take the storage facility's word for it. Ask for audit reports. Ask for proof of insurance. If you have allocated storage, ask for your specific bar numbers. Consider visiting the facility if possible. Third, understand your rights. Can you take physical delivery? What's the process? Are there any restrictions or fees? What happens if the storage facility goes bankrupt? Fourth, consider diversification. Don't put all your gold in one location or with one custodian. Spread your risk. Maybe keep some gold at home in a safe, some in a bank safety deposit box, and some in a private vault. Different storage methods for different purposes. Fifth, stay informed. The gold custody landscape is changing rapidly. What's true today might not be true next year. Keep up with developments in the industry. Review your storage arrangements periodically. And finally, think about why you own gold in the first place. If you own gold as insurance against financial system instability, then your custody arrangement needs to reflect that. Gold that's tied up in a complex custody structure that might be inaccessible during a crisis isn't serving its purpose. The whole point of owning physical gold is to have an asset that's outside the financial system, that maintains value when other assets don't, that gives you options when other options are limited. But if your custody arrangement doesn't give you real control over your gold, then you're not getting the full benefit of gold ownership. Look, I know this is a lot of information. Gold custody is complex, and it's getting more complex as the market evolves. But here's the bottom line. Custody matters just as much as ownership. Where your gold is stored, who controls it, and what your rights are can make the difference between gold that protects your wealth and gold that becomes a liability. The changes happening in the gold custody world right now, from central bank repatriation to new storage technologies to increased regulatory scrutiny, are all pointing in the same direction. Custody is becoming more important, not less. So if you own gold bars, now is the time to review your custody arrangements. Make sure you understand exactly where your gold is, who has control over it, and what your rights are. Because in a world where financial sovereignty is increasingly important, the custody of your gold is not just a technical detail. It's a fundamental part of your financial security.